Hey guys, I'm here preparing this message for you because a bunch of you have been asking me what what is my take on what's going on and what is my game plan for what is happening next now that things are getting so turbulent. So I'm going to go fairly quickly. So it's a short video and you can go back to it and review if you want. So what are the variables that I'm looking at and that make this recession that's coming special? We have primarily multiple countries with a very large amount of sovereign debt, and they are all tightening at the same time because they're all experiencing inflation and they're all suffering from it. It's really having an impact, especially as the US dollar is getting tighter thanks to the Fed. The COVID made everybody reset and start over at the same time almost and reach the end of their cycle at the same time. This brings complications because there's no give anywhere. Any country pops up, it affects almost everybody else at the same time. So for that reason, we're looking at having the very top G7 countries presenting some of the biggest risk. Although there's only been a few countries that are starting to have serious problems like the UK, Sri Lanka, it's very rare that you're going to see a G7 country be some of the first ones to blow up. That shows you how wound up and how indebted the richest countries are. This is a result of years and years of buildup. On top of that, we have a situation with oil that is becoming increasingly important to the world economy as the primary source of energy. And now it has actually found a way to rise above the importance of the sovereign currencies, because oil now is being settled in very specific currencies, and it's currencies that many countries are up against, and the price is soaring above any currency. And that is not going to slow down. So those variables are brewing a very toxic collection of issues, of variables that you put it into, mix it up with a last sprinkle of geopolitical tensions and the chance of war and political polarity happening everywhere. And we have the makings of something that resembles the 1930s and 1940s. So how am I playing that? There's a short term and then there's a longer term plan that I have. When it comes to the shorter term, I think that what you have seen in the market so far has been the result of the tightening policy that the central bankers are putting in. So rates are going up, house payments, everything is going up. Prices at the food basket and other things are going up, rents are going up. So this has already caused a reset of the stock market. Prices are definitely coming down, and that hubris that we had before is not there. But there is something else that's going to happen that has not been accounted for. It's not priced in yet, and that is the revision in earnings of corporations. The prices today of the stock market are taking into account that corporations are still going to be selling a lot. Unemployment levels are still manageable. There's a lot of M2 velocity, which is the amount of currency that's moving through the system and how much savings people have. There is an expectation that people have kept spending. And I believe that is going to change. Either this quarter or pretty shortly thereafter, companies are going to revise more. We've already heard that companies like Amazon, Walmart, Target, Adobe, Micron, Intel, Nvidia, among many others, have already been warning shareholders about potential slowdown in consumption. Hewlett-Packard, it's going to be everyone. And that's going to then change not only the multiple that you pay for earnings, but also the earnings. So you should expect markets to go down. Therefore, for the immediate future, I expect a lot of volatility. Some companies will report good quarters, maybe Google, and some others will report terrible quarters. So there's going to be a lot of choppiness. The US dollar has been running up a lot. It's up like 10% this year. Anybody holding US dollar has done very well. But it doesn't go up forever. So that might change a little and might give some impulse to bonds. So I like bonds here, and I like oil for the reasons that we talked about previously. This continuance of earnings and this next leg down is going to put the Fed in a difficult position. It's up to the Fed to decide what they're going to do. And other central bankers are going to begin to have issues as well with their own economies. The Fed doesn't have to save everyone. They have to look after their own interest. But at a certain point, other problems will become their problem as people are not able to pay their US dollar sovereign debt. Also, you probably have noticed or not that a lot of countries are having to sell their treasuries and bonds and savings in the United States. They're calling them back in because they need the US dollars to be able to keep paying their sovereign debt. The US dollar is so expensive and there's been such little consumption and tourism that countries are not getting the usual amount of US dollars that they get, and they're not able to save them. So they're having to go back to the piggy bank, and the piggy bank is the United States. So this is affecting the liquidity in the United States, and something is bound to break. If the Fed continues despite earnings revisions and what's coming up, they're tightening and their stance to fight inflation, then you're going to expect some problems to become systemic. And systemic means the foundations of the economy are going to start to buckle. If you get enough dollars leaving the country and you get enough of the risk being removed, the next leg of problems will likely be pension funds and other savings funds that are large, sovereign funds, large wealth funds. Some of the companies like BlackRock and Vanguard who save money for people are going to be struggling. And until they start to really buckle, I don't expect the market to do anything about it. I don't expect the Federal Reserve to do anything about it. These pension funds have had to take on more risk because there was no yield. Don't forget that bonds were giving almost nothing. Money was almost free. There was no returns to be seen on any fixed income. So these pension funds went out on the curve and started taking on more risk. So as the market goes lower, the value of their collateral will go down. So that'll be a problem. And I think that is what's going to ultimately break the faith of, or the capacity of the Federal Reserve to continue to protect the currency. Therefore, longer term, there is going that choppiness that I'm talking about, where bonds are going to be more important, and perhaps a gold buildup will be important. I think at some point, and if you get the timing right, you can do really, really well. The Federal Reserve is going to pivot. It's going to stop tightening. Is going to have to backstop the economy and save us from a complete meltdown and collapse. That is going to soar the stock market. So if you have any stocks that are your favorite, where there is a lot of commodities, oil, iron ore, gold, silver, palladium, copper, etc. Those, or they're miners if you don't want to buy the specific material, will be great. I like some like Newmont, I like Rio Tinto, I like London Mining, Occidental Petroleum. All those I think are great candidates to be looking at, but you can look at your favorites and start loading up. It's going to be very difficult for everyone to time it just right to find when the Federal Reserve finally finds the spot, but I expect the stock market to go down a lot between now and then. The Federal Reserve won't just turn on a dime just because on a whim. There has to be true damage to the economy for them to do it. And it could be a recession or it could be worse before they do anything. But this is a human making the decision, so we don't know exactly when that's going to be. So there's nothing wrong with starting to buy here. The market has corrected quite a bit, but you should know that the market is going to go down. It could be a lot before it rebounds. So you have to be okay seeing the market going lower and lower. But if you want to wait out and time it, go ahead. I'm going to try to do that a little more with our funds, but you don't have to. It's up to you what you decide. And the big factor you need to keep into account when you get there is you're going to notice that the Federal Reserve's job is not done. By that I mean inflation has not been fully killed. There's going to be a lot of stickiness to it, and things broke before they could get the work done. So the patient is going to remain sick. So if the Federal Reserve and the central banks of Canada and the US and whatever other country decides to print money again or do QE, then the currency is going to really devalue. You're going to not want to have currency in your hands. Turn your currency into something else. Any of the assets that you like to buy, that you understand well, real estate, airline stocks, something, I don't know, whatever it is that you know and understand well. Because currency is likely going to be the release valve for things. You've probably noticed that the Canadian dollar went down quite a bit after COVID. And how do you know the currency is down? Because the price of things went up. So you go buy an apple and see how many dollars you need versus a year ago. Well, that's going to get worse. But assets are going to go up. So if you hold assets, you're not going to notice the change in price of Apple because it's the same as selling a stock of Apple. That is it. That is, in a nutshell, the strategy and what I'm looking to do and how I see things. There could always be something go wrong, and there's a very high likelihood of something going wrong. One of the things that I've decided to place this time around, I rarely do, it's called a hedge, which is a derivative position that can pay exponentially upon a market calamity. So if there's a war and everything just collapses in the economy, this would have a huge payout. It would go geometrically higher. So look to see how you can become anti-fragile by having things that soar on things going wrong, because they will. People are not going to just accept this, especially middle class and lower who don't have any assets, and all the few savings they have is in currency, and costs keep coming and their salaries are not keeping up. There is going to be a discontent when this happens. But this is not a permanent thing, and we'll see how it unwinds. But make sure you're positioning yourself best to handle it. So, good luck. Let's all see how we can get through this. And if you have any questions, let me know. I'm happy to share with you guys. Anybody seeing this video, take care.